About the psychology inside market action. I'm Martha Stokes. This is a educational format. I'm not recommending stocks. I never do. I teach you how to find your own stocks. Everything is copyrighted. Psychology inside market. Martha Stokes, CMT. I am a chartered market technician, which is the highest degree you can get in technical analysis. It is a Series 86 approval, giving me the permission to teach and do research analysis. I'm a long-term member of the CMT Association, CEO and co-founder and head instructor of TechniTrader, which was started 26 years ago when I retired early, and my trading floor manager convinced me to start teaching, and I thought he was crazy. It took a year for him to talk me into it. But I enjoy it, and it's my legacy. I have published the doctoral thesis as a professional thesis of cycle evolution theory, how to identify evolutionary cycle deviations, and this has changed the understanding of cycles and deviations, and we've had major ones recently. And I also have published my theory and doctoral professional thesis on relational technical analysis, which I'll introduce to you today, and both of these are in the CMT organization. So, psychology of the market. Psychology of the inner market is the difference between how professionals of the market trade and how you trade or invest. Retail traders and investors are never told or trained about how the market actually works. You read all this retail stuff and I just like shake my head. The stock and financial markets of the US are the largest in the world. We have 8 financial markets, including cryptocurrency, and all of them, we are the largest in the world by none. If all the stock markets of various countries were combined, the US stock market would still be the largest by a huge margin. That means the stock market is complex, far more so than you can imagine. It's impossible for you to fathom how complex it is, but I'm going to lay it out for you today because that is the psychology of the inner market. Is it hard to learn this complexity? No. I have lots of students that understand this, but until you set aside most of what you have heard or believe, you will be stuck in what is called the hobby trader zone. What that means is you trade emotionally without awareness of the market because you don't understand what's going on. Every morning they go, oh, investors did this. Oh, investors decided to sell because which ones? Which investors? The market isn't one great big herd of investors. There's all kinds of people out there. What is the inside market? The inside market is where all the various professionals of the market transact the business of buying and selling stocks. The stock market is the business of businesses. Hold your questions till the end of the term, because if you need to understand that, I will explain that more at the end. This inside market is also known as dark pools of liquidity. Dark refers to the fact that none of these transactions are visible during the day on the public exchanges where you and all the other retail traders and all small funds managers buy and sell stocks. This is a big deal. Pools refer to the massive quantity of stock and capital available in these hidden venues, and I will give you those numbers. There are over 143 trillion, that is a T, $1 trillion in assets worldwide on the professional side of the market. It is massive. Do the professionals worry about the debt of the US government? No, they have plenty to cover it. Liquidity refers to the transaction time, which is on the millisecond scale. You trade on the minute scale. That's a big deal. Inside market, the buy-side institutions are often called dark pools. They are the most powerful participant group in the market today. Buy-side institutions, sell-side institutions. Those are 2 keywords. Write them down so you have it, because you'll forget. The dark pools are the giant mutual and pension funds that have trillions of dollars of assets under management worldwide. We have 78 million families who have 401ks, often more than one in the market, and they're managed by the buy-side institutions. It's massive. The sell-side institutions are banks and financial services giants such as Goldman Sachs. These institutions make the market, underwrite IPOs, and have huge trading floors with the best floor traders in the world. They are really good. So sell-side is short-term trading. Buy-side institutions are long-term investing. We got that, write that down. HFTs, also known as high-frequency trading firms, are programs under massive multi-million-dollar to billion-dollar computers that make the market or take the market and provide liquidity to the exchanges, because most of the activity is not on the public exchanges anymore, and they are all fully automated. They are what cause the gap ups and gap downs at market open. The independent professional traders who you never hear about, they don't want to talk to you. They don't want to help you. They don't want to do anything with you because they are making so much money and they're having a great time because they're at home, having a good time, making a lot of money and enjoying life far more, which you should be a part of. You should be semi-professional. That's where you want to go. But you're held back because you don't understand the inner psychology of what's making this market do what it does. Derivatives developers who create all kinds of trading instruments for the stock market, ETFs, ETTs, ETCs, the new BTCs and ETCs, all of these are all derivative developers, and they make a major part of it. So, impact of dark pool activity for the financial markets. Alternative trading system venues, also known as dark pools of liquidity, have been around now for over 22 years. How come you haven't heard about them? You should have heard about them by now. When you first started trading, when you first did that first day trade, you should know about them. These dark pools with their peer-to-peer over-the-counter transactions are intended to eliminate or at least minimize front-running of giant lot traders by HFTs and retail groups. Dark pool activity now constitutes a huge majority of all financial market transactions. It's massive. So we have all this dark pool of liquidity you can't see, you can't trade on, you have no idea. I know that there's some whales out there. They say, oh, we can find the whales. Oh, look, 50,000 shares. Oh, 100,000 shares. Woo! That's not a large lot anymore. With over $350 billion changing hands every day in the stock market alone, the magnitude of the dark pool's dominance should not be underestimated because it's a massive part of the psychology of the inner workings of this market. This is an area of study that both retail and professional traders need to learn and stay current with, how these dark pools influence price trends and bull to bear cycles. They make the bottoms, they make the tops. There are currently 50 ATS dark pool venues offering these hidden venues for the giant to large buy-side institutions. There's about 25 to 30 giants, and there's a couple hundred large buy-side institutions, mostly pension plans. We have pension funds. We have 1,000 Fortune companies with all huge 401ks. So we have that. Why does this matter to you? The majority of the stock and financial markets use fundamental analysis with quantitative formulas and analysis. You're technical traders if you're trading, day trading or whatever you're doing, but the fundamentals are there in the charts. However, all fundamental data that is reported quarterly, like we have our earnings season right now, or even monthly, is historical data. It's what happened 3 months ago. It is not what is happening at the moment, in this moment of time. Relational technical analysis is my professional term. It uses current data compared to historical data with an understanding of how dark pools impact price and indicators to provide a complete analysis. This grounds your trading because now you're focused on what's most important in the market, not, oh, Netflix is going to become a $1 trillion market cap. That's not important. Fundamentals do show up in the stock chart if you know what you are looking at, what the candlesticks, indicators, and trends are indicating. It's right there in their charts, but you don't see it. It's like you need to learn the language of the market. You need to learn the language of the candlesticks and the indicators. This is a language barrier that you have. Understanding where to find dark pool activity on a stock chart gives you the ability to trade a stock before the huge runs and gaps in HFT gaps pre-market. So dark pool buy zones are on a stock chart. They're very narrow. This whole thing started out and they had different places, but they did form this lovely bottom here. When the stock starts running up like this, those are when the pro traders are getting in. The consolidation areas are where the dark pools are formulated. And we have special indicators that show this transaction. They were written a while ago and they are excellent and get better every year because the large lots are dominating, the dark pools are dominating. Then we have hidden quiet accumulation in here. If the price goes below their buy zone, they stop, they pause. If their price goes above their buy zone, they pause. So it's a very specific thing that you need to learn. What are dark pools and why are they legal? This sounds so illegal. The SEC is protecting 78 million Americans' 401ks. Dark pool venues, or ATS, started out with a few giant funds requesting off-exchange venues so that the then new high-frequency trading systems would not front-run their buy orders. When we changed from fractions to decimals in 2002, everybody that was trying to front-run the dark pools, which were on the exchanges in those years, went to high-frequency trading, plugged their computers right into the exchanges because the exchanges wanted the liquidity, and all of a sudden they were front-running the dark pools, and dark pools said, we can't do this. HFTs are fully automated trading systems, and they go around and they look at social media, and they look at news, and they look at technical systems, and they listen to your chats in your chat rooms, and they listen to anything that's publicly out there, social medias. And then they the computer assesses it, does this little AI thing, and then front runs you. The off-exchange transactions in 2005 accounted for less than 5% of the activity of the stock market. Today, dark pools constitute approximately 50% or more of all transactions. Large lot professional transactions, including dark pools, constitute 80% of the market activity. Whoa, you're just 20%. You're not. You have to get with the program, guys. You have to get with the program. And it's more than just controlling and discipline and all that. It's understanding what's going on so that you go, oh, I get this. Okay, I see that. And so it starts to make sense. When you can use this information, the matter of discipline disappears. Hence, the retail side of the market, despite its millions of investors and traders, accounts for only 20% of all the transactions daily. Public exchanges show only the retail groups and smaller funds activities. Small funds managers with less than 3 billion of assets under management are on the retail side. They're not on the professional side anymore. SEC made that determination. Dark pools put in a specific price range. My time-weighted price automation will halt if it goes above it, and my time-weighted price order will stop if it goes below it. So they have this very narrow price range because it's just this penny spread they're trying to hit. And if they have professional floor traders, and a lot of times the pro traders will be hitting the penny spread, and they're so delighted. I've been on the floors of these professional institutions. And it's really fun because they like to hit the penny spread or the half penny spread, which you don't even have access to. This stuff all happens on the millisecond. We have high frequency traders moving the market dynamically. We have retail traders chasing them. We have smaller funds chasing them. The market is complex. SEC Midas, check it out. Go to the SEC website. It's great and wonderful. Teaches you all kinds of things. SEC Consolidated Audit Trail, or CAT. After the 2010 flash crash of the stock market, the SEC started building the CAT. This extraordinarily complex system checks and verifies every stock transaction. Whether there is one lone dark pool, huge block order buying a huge lot, 25 million order or so, as smaller funds, retail investors, retail day traders, and other market participants sell because they're scared because they read something in the retail news, CAT can and does identify each and every single individual who sold stock for that particular order. Whoa. While the dark pool gathers shares of stock as one entity buying, hundreds of very small lot orders are filling that buy order across all exchanges, brokers, dealers, etc. Each participant in that order it can be identified. If some bizarre flash crash occurs now, SEC knows exactly who instigated that crash, and he'll get fired. The guy, the fat-fingered fundamentalist who set the E-minis futures on fire by doing a VWAP rather than a TWAP order, was fired. It took 6.5 months to find out who it was, and the company went out of business. So we do protect our investors and traders. You want to understand what's going on. This is the psychology. behind everything that happens, not your retail news. Dark pool buy and sell zones. With their ability to trade on the penny spread, dark pools can control the movements of price up or down with minimal impact on price while they're in accumulation mode. They want to buy on a specific penny price spread. They don't want to have to pay more than what their fundamentally quantitative formulas tell them is the right price. It's so compact and it's on the charts. You just don't know what you're looking at. Rotation also functions similarly. I call it rotation because rotation is where they're selling incrementally in a small price range, lots, hundreds of shares or millions of shares of lots, that they want to reduce the inventory of, let's say, Tesla, and they want to be buying Apple or whatever, okay? So there's this rotation accumulation going on, and you need to understand that and see that in the charts as well, because this will be a fundamentally important psychology that you use. Dark pools tend to use quantitative analysis formulas to determine the price range within which they will buy or sell a stock. That's just what they do. Then they set the automated order and away it goes. I call these narrow ranges of horizontal trends buy zones or sell zones. How many of you been in the market for 10 or 15 or 20 years and you've noticed, gosh darn, this market is always going sideways. It's always going sideways. There's consolidations, there's sideways trends, there's platforms. Wow. Platforms are part of the buy zones. If the stock moves above or below the range designated, then the dark pool TWAPs or other bracketed controlled orders halt the pause. Now, if they can control their entry, why can't you? You can. You just have to use a controlled bracketed order. You're often using limit orders and you're buying into weakness. Bad idea. This creates a pattern that can be identified using relational technical analysis, which includes the study of the price action, the trend, behavior, and hybrid leading indicators with an understanding of dark pool activity. So the most important thing you can learn is this stuff. This is dark pool. Pro traders get in a little bit. Pro traders run it up. Some smaller funds chase it. Then it kind of collapses down. And then HFTs or memes groups or retail groups buy it. And it runs right up. The pro traders are in there making profits, selling, having a great time. They have a lot of fun with this. You will find if you do a little rectangular outlines that the market often goes sideways. These huge gaps, HFTs, always. Big, long volume bars, HFT gap, that's an HFT gap. So that's who's controlling it. It's not investors gapping the market open. It's HFTs. So you need to understand this. And these areas of accumulation are very, very narrow. And there's a lot of them when they're accumulating. They show up all the time. What you want to do is get in with the pro traders nudges. And then as it starts, here's another nudge. And then just ride it up. And you don't want to be day trading. You can't make enough money on that. You can make enough money when you hold and it runs up quite a bit. That way, you don't have to trade every day. You can make money all month long and you trade less. Less is more in the market. Why most retail traders miss the buy zones? Most retail day or swing traders miss the buy zones because they use outdated price and time indicators. I hope you all know what that means, price and time. If it doesn't, ask me, but there are data sets and I'll tell you at the end of this session what's going on. Price and time indicators were written prior to the dark pool ATS venues. They were written in the 50s. George Lane, stochastics, they were written in the 60s. Gerald Appel and his MACD and RSI by Wells Wilder, who just passed away a little while ago. Dark pools do not disturb price. They hold it in a narrow price range. They are so powerful that they can just keep that price in a certain range. That's what makes it so easy to trade with them. Right now, you're trading against them. Hybrid indicators reveal dark pool activity. We need to know where they're pinging and how they're pinging. These are two of the line indicators. This is a volume oscillator. How many of you use volume oscillators? Did you even know there are volume oscillators? Flow of funds moving in or moving out. A fundamental information is going on in these charts and you miss it. These indicators incorporate more data in a sophisticated formula you don't have to worry about. You just have to learn how to see what patterns are things. Notice how this stays above the center line all the time. Notice how this incrementally goes up and goes up. They're accumulating. Some define which side of the transaction the large lot is dominated. Data must include uptick and downtick. So it's a very sophisticated formula. Retail traders tend to use outdated indicators that no longer work consistently in the stock market of today. I don't care what indicators you use, but for gosh darn, use some of the indicators that are going to show you where the dark pools pro traders are, because there's tons of pro traders making a lot of money out there. I have a lot of them that work with me, and they make great money. This creates inherent risk that can cause losses when you don't understand that you're using insufficient indicators or outdated indicators for the modern market structure. There's a lot of automation in our market, but it's not all automated. So how do you currently trade? This is kind of a little cheat sheet. Are you day trading or investing? You should be doing both, but day trading is a bad idea. What you want to be doing is trading as a business for monthly income. The IRS has special rulings, and you don't have to fill out those long forms if you're not a hobby trader, but trading as a business. You can take off the expense of your office. You can take off the expense of your electricity. You can take off buying a new computer. You can take off all of your education, all of it, if you're trading as a business. If you're a hobby trader, you can't take any of that. You can't even take a loss against your other income. Indicators, are you using just price and time indicators? Not good enough. Or are you using quantity and large lot versus small lot indicators and all the hybrid leading indicators that are current for this market that the professionals are using? Entries, are you using indicator crossovers or reversal or continuation candles? Bad idea. Crossovers are a price and time. By the time you see the crossover, price has to move up before it can cross. So you're late. You're late. This is a penny spread market, guys. You can't be late. Reversal and continuation patterns, half of the wonderful candlestick chart candles that were in the Japanese candlestick original books don't work anymore in our market. Why? Because it's a penny spread. Why? Because that was the 1600s of Japan. It was a commodities market, and rice was a currency. These are stocks. It's different. Currencies are traded and commodities are traded entirely differently than stocks, because stocks are an actual asset. Okay. Or are you using candlestick buy and entry signals that are current? Or there's the modern candlestick buy entry signals that tell you exactly to when to get in, the pro trader nudges, the push, the nesting candles. There's all kinds of candles that show you when to get in. Stop losses. Are you using percentages? Oh, please tell me you're not, because everybody knows the retail brokers that you use, and you must use, you have to have a broker to get to the exchanges, have to light your orders in the morning before the market opens and during the day, before they either fill them from their inventory, which nobody is doing anymore, their PFOF, payment for order flow. So they send it to a market maker and he fills the order. And so then your broker makes money by sending your order to the market maker. The market maker makes money because he's always on the right side of the trade and he makes profits from the spread. So don't use percentages, because they're going to knock you out. They're going to knock you out. I'm sure everybody says, oh, stop losses don't work. They don't work. Sure, they work. You're just putting yourself out there and saying, please, fill my order. Technical support levels that are appropriate for the trading style you are using. Okay, you have to have a trading style. Finding stock picks. Are you using news, gurus, news recommendations, and so on and so forth? Why are you relying on somebody else? They don't know you. They don't know your capital base. They don't know your experience. They don't know how you're trading. How can you trust them? And they're always in the stock. They say, oh yeah, I bought the stock. You should buy it too. Oh, isn't that guru so smart? His stock always goes up. Of course it does. He's got 1 million followers. Or are you using charting software scans, source designed to find dark pool buy zones so that you can get in before the price runs, before the price moves, before that crossover signal? Yeah. Determining market conditions. Are you using futures, retail news feeds, and indexes? Bad idea. Right now, the indexes are doing one thing, and the broad base of 6,000 other stocks are doing something completely differently. So all my students are trading all the small caps and where the dark pools are, because it's a complete mix. Market technical indicators and market condition analysis, and I'll show you my analysis and how I use it in a little bit, are what you need to do. The market open doesn't define how the day will go. It may whipsaw. It may go up after gapping down. It may go down after gapping up. The open doesn't tell you anything but how the market's going to open. That's it. That's all it tells you. The difference is you are trading like it's 1999. In the 1990s, when the first retail brokers came online and everybody could trade online, it was like, wow, wow, day trading. There were hundreds of day trading little shops where you went in the early morning and you were day trading everything. They tried to hire me and I told them no good, because I could see that it was just a lot taking their money. Or are you trading the current market with all the variables and new trading instruments that are available to you in a software program? I'm not a software company. I don't have a software. I have 3 or 4 that I recommend. Beyond the basics of technical analysis, if you want to be consistently profitable trader, you need to learn more than just the basics of technical analysis. That's just like reading a basic book on anything. The basics are a good start, but in order to make the income of a professional trader and the confidence and discipline of a pro, you must learn more than just candlestick continuation or reversal patterns. You need to know more than just MACD, RSI, Bollinger Band, stochastics, Fibonacci, or Elliott wave theory. These are fine, but not enough. Why? Because they're all price and time. They don't tell you what's going on in the dark pools. They don't tell you what's going on in the largest amount of money pumping through our huge stock market. You're missing the boat. All professional traders incorporate far more advanced indicators called hybrid leading indicators. And some of those that I use are being used by professionals also. They also customize some of their indicators. The new hybrid leading indicators reduce risk, improve analysis, and increase profit potential. And when that happens, your self-confidence goes up. When your self-confidence is up, you make fewer mistakes. When you use a trader management planner, you document, you type in all the stuff. There's no mistakes on your addition or your multiplication or whatever. Discipline isn't hard. It's easy. You just have to be doing the right thing at the right time. So you have to learn how this works. Hybrid leading indicators take the guesswork out of trading and eliminate emotional decisions, period, because you know what's going on. Market structure basics. A professional trader trades very differently from a retail trader, and I know a lot of them personally. They are aware of the entire body of market participants, what each is doing, and how that market participant impacts price action. They're aware of who they are trading with and who they are trading against. Every time you trade, you need to know this fact. They see all 4 positions within a trade. What are the 4 positions of a trade? Buy, sell, sell short, buy to cover. They're all very specific. Selling short requires margin. They understand the enormity and complexity of the markets. Professionals use special order types and commonly trade 1 to 5 million shares and a transaction with anywhere from 5 to 10 legs. A leg is an options put. I've just bought 5 million shares of such and such a company, and I want to mitigate my risk, so I'm going to buy this many put options on it. And I'm also going to buy a few futures. I'm going to buy the ETF that this company is associated with. So I'm going to buy the Qs, and or I'm going to sell short the Qs, and then I will have this balance and control going on. It's complicated what they do. You want to be with them, not against them, because when you're against them, you lose money. And you go, gosh darn, the market makers, they're always ripping me off. Wow, it's just so hard to trade this market because everybody's against me. No, you're trading against them, and you want to be trading with them. And when you trade with them, your confidence goes up. It just becomes so much more fun to trade. They use special indicators designed to identify which side of the transaction the large lot triggers. They don't want to be on the wrong side of the trade. They want to know where those large lots are, and they know they're out there. So they're poking around. He only has four screens showing. Most of my friends have 6 screens that they monitor. Independent professional traders hunt the dark pool buy zones. They hunt for them. They create the candlestick patterns called nudges, which trigger HFT automated orders to gap. So dark pools are down here. They're creating all this activity. Professional traders can see that because they're looking for it. They have all the tools and all the indicators and everything they need. Okay, this is an accumulation because it happens over a period of time. It can take 3 months or 6 months. It can take 1 month, but they can see these patterns going on in the charts. Oh, they're accumulating this stuff. And you can check the percentage of shares held by institutions and you can see what's going on there too. And then they say, okay, we're going to nudge this price out of this buy zone that the dark pools have created. We're going to nudge it. So they do this little small candle. The volume and the other indicators show that they're nudging. And HFTs see that nudge and they think, oh, that is a buy zone. And the HFTs automatically gap it up. And then what do the pros do? They sell it. Foundational knowledge. There are 6 primary market conditions. The bottoming market, the trading range market, the platform market, moderately trending up or down, a velocity up or down, and topping market. So which one are we in right now, guys? Anybody know? Write down your answer and then you can check it. We're in a moderately uptrending market condition. We're in a bull market and it had just a little correction going on and it's going to have lots of little corrections. So you got to get used to that because it's going to happen a lot. Earnings were better than what was retail side was told. Each market condition is unique. The trends, the trend line patterns, most of you don't know what trend line patterns are, but I will teach you, are different. This is because different market conditions are created by different market participant groups dominating and controlling how price moves up or down. When we have a velocity market condition, all the professionals are just sitting back going, wow, look at the way those retail traders and retail investors are buying speculatively, gambling. Wow, that's really going up. I'll move my trailing profit stop up, but I'll just keep holding until I see that they weaken their volume and their activity weakens, and then I'll sell. Platform markets are built on dark pools. Bottoming markets are built on dark pools. Trading ranges are where the dark pools are not participating in that particular market. Topping occurs because the dark pools see in ahead what's going on and they want to get out of that stock or lower inventory. Market condition is your roadmap for navigating the market activity over time. You're trading on a 1,000-lane freeway and not everybody's going in the same direction. You will trade differently in a velocity market than in a platform market. The stock market cycles and each market condition is a different part of that cycle. So be aware of that. All of you probably learned this and it doesn't exist anymore. Charles Dow wrote the theory of 3 levels of market participants. He is the father and the inventor of technical analysis, and it took him years to prove to people that the market cycles, and it does. And this is from 1890, and it's still taught everywhere in books and gurus and all these other places to you retail people. Yes. Banks, wealthy individuals, and corporations account for 50%. These are the informed buyers. They know what they're doing. They get in low. Then when the market goes up and then it comes down on a dip, then the average investors get in at 40%. These are the upper middle class, high middle class Americans that are buying that. Then we have our uninformed investors who are low income, poverty level, but have a little bit of money or a little bit of money or win a little lottery ticket or something. So they buy at the top because they have no idea. They just think this market is going to go up forever. Of course, it doesn't. It turns down, they lose all their money. This doesn't exist anymore. There are far more than 3. It's not Main Street versus Wall Street. Dump that. Okay. Bull market cycle of the market participants. Buy-side institutions, also known as dark pools, are the ones that create the bottoms. They slowly accumulate stocks as fundamentals improve long before the earnings seasons ever show it. And they are very wise and very savvy. They go out to all the companies that are major companies and they sit down with that CEO and CFO and they say, what's going on? What are you doing? They talk to the board of directors. They're huge. They're the most important investors that corporation has. And the corporation is willing to buy the most expensive Starbucks coffee they want. And they take them on tours and everything else. The buy side knows way before earnings season what's going on with that company. But they don't tell you. Wealthy private investors are all the billionaires of our 100 millionaires of our world, and they are savvy because most of them are like Jeff Bezos. He was a nobody that has an idea to sell books called Amazon, and he built this huge corporation, and he became a billionaire. And he invests in the market, and he's very savvy, just like Bill Gates and Steve Jobs and everybody else invested in the market. All the smarties do, because they know business. The market is the business of businesses. The stock market finances the corporations by having market cap large enough that the corporations can sell their bonds or acquire debt to build the company and grow it. Take it seriously, folks. It's important. Professional buy-side traders also are in there. Professional buy-side traders pretty much do little extra works here and there, buying smaller lots or half lots. They also boost the ROI, the return on investment for the investors in 401ks and mutual funds, so that whatever the institutions promised their investors would be a likely return on investment comes true. Okay. So professional traders are independent. There's a ton of these, mostly from the sell side. Sell side institutions are the big money central banks and the financial institutions like Goldman Sachs. There's not many of them left. This is the smallest of the groups. These have far more entities than this. There's only about 5 or 6 big banks left and only a couple of the giant financial institutions. So they also have floor traders, and they are short-term. They're not long-term investors, but they can get in there. And sometimes I say, guys, we have the sell side institutions. They're forcing this market down. They're selling it down. They're pushing it down. And they also do the buybacks for big corporations. They sponsor that as well. So they do buybacks as well. High frequency trading and hedge funds are here to stay. They provide a tremendous amount of liquidity. They gap up or gap down at market open. They're mostly before the market opens. They fill the queues with the orders up or down, and they gap the market in that direction. That's their primary focus. You don't see them much during the middle of the day. Sovereign funds, foreign funds, nonprofits. Since we are the largest and have 6,000 stocks to invest in and tons of ETFs, 3,000 more ETFs, everybody wants to be in our market. So either they buy from their exchange or they buy from our exchanges. And so these are on the retail side because these are really small entities. Small assets management companies with 3 billion or less assets under management, small funds, small hedge funds, AAII, and investment groups are all on retail side. Memes groups, retail traders, smaller investors buy late. You're always getting in late because you wait for the market, that beautiful crossover. Oh, MACD crossed over. Now I should get in. And professional traders are going to sell. Retail trading groups get in very late, and a lot of investors are doing what they've always done from the beginning of the stock market. 80% of all market activity is professional. These are the guys you want to be with. 20% of the market activity is the retail side. They're uneducated. They don't know what they're doing. They have no idea this exists. They don't understand it. They don't get it. And so you don't want to be with these people. You don't want to be trading with these groups. You want to be trading with these groups. You want to be getting in at the right time. Then your trading is going to make money. You're going to have self-confidence. You're not going to be going, why do I always doubt myself? Why do I always doubt myself? Because you're losing money. It hurts. It's a grief. It's a loss. It hurts when you lose money. It lowers your self-esteem. You feel like you're not worth as much. It's a social thing. And you need to get rid of it by being consistently profitable. And this will help the whole market. This is the sell side. They start selling and they bend the trend as they start selling because they sell on the high side. And it slowly starts bending. And when everybody sees that, sell side institutions see that bending, they go, okay, let's sell short. And they just sit on those sell shorts, okay? Because they have their buy covers way lower. Personal traders also get in on that because they'll be selling short. These try to support the market. High frequency trading funds gap and run stocks down. We've seen some massive gaps and rundowns recently, and that's important because they're wrong. Their AI screwed up. Sovereign funds tend to either buy on the dip or wait a little bit longer and then get out. Small funds investment groups also buy on the dip and then get out late. Retail traders, chat groups, memes groups, they go, oh, maybe we should be selling short. You're late. Small lot investors often hold. I'm a long-term holder and I hold forever. I hold the stock even when it goes into the dust. Why? I thought we were in this market to all make money together. Odd lot investor waits because they capitulate at the very end. Meanwhile, somewhere around this level, buy-side institutions start slowly accumulating and buying because the fundamentals are below the price. Bear markets always drop price below the fundamentals, and the dark buy-side institutions go, well, I just can't resist this bargain price stock, not cheap stocks, bargain price stocks. The fundamentals are below the price. So they start accumulating and they make the bottoms. Okay. Psychology of market participant groups. You need to learn how, why, and how each of the 12 different market participant groups affect price and volume, because they all do it differently. Each group has a distinctly different footprint on the stock chart. Within the group, the trading activity is very similar. So all retail traders trade the same, especially day traders. Very boring. You must understand the wide disparity between the groups in terms of venues. Dark pools have a different kind, ATS venues. Are they trading with lit public exchanges or the dark pool ATS venues, or buying directly from the company? In the morning, I'm looking for giant lots. I have 43 million shares bought from a company recently. Wow. Okay, yeah, that stock is going to go up. What order types do they use? Speed of execution. How fast? You're on the minute scale, and that's as fast. And of course, it's just seconds after you enter the order, because your broker has this cute little AI thing that sees you typing in what you're typing. So they're already getting ready to send the PFOF out there. It goes out on the millisecond. It comes back in a second. Yeah. So they have a lot of access to information you don't have. Their lot sizes are huge. Your lot sizes are 100 shares, 500 shares, 200 shares, 1,000. You think 1,000 is a lot. And why are they buying? Long-term investment, mutual fund investing? What are they buying it for? Over the past few years, the financial markets, especially the stock market, have fractured into multi-venue structures that never existed before. So if you're reading these old books or learning from the 90s, it doesn't apply anymore. Relational technical analysis makes it easy to recognize each group's footprints on the chart. That's why I created it, because I saw this. This is an example of the tools for trading. This is my original market condition analysis for my trading floor many, many years ago. I've been teaching for 26 years. I retired very early. This was done because I needed my floor traders to be able to determine what the market was going to do. Okay, how many stocks on this particular day moved with strong momentum? How many stocks on this particular day moved to the downside with lots of momentum? Which one has the higher number tells me that the bias of the momentum is to the upside or the downside. Very important for trading, don't you think? And then dark pools, are they accumulating? Are HFTs chasing them? And how much is going on? Bottoming stocks. How many stocks are in bottoms? Because that tells us if the dark pools are active. The dark pools are really active right now. There's tons of activity going on. Consolidations, that's your pro trader. They like to hit the penny spread. So their price action is going to be really infinitesimally small and really consistent across the line. That's why we have so many horizontal trends. Trading ranges. Do we have a lot of trading ranges, and are they turning at the top of their range? That's important. And I have a scan that compares price to previous price over a set number of days behind. So is price improving? Are we stuck in a sideways pattern? Right now, we're kind of stuck in a sideways pattern. And that's important to know. So I put this together. I write a morning market report. I open the market open report based on what you see when the index is in the retail side. And then on the professional side, I do this market condition report that tells you how to trade for the day. Tools for disciplined trading. You need market condition analysis of some sort. You need relational technical analysis. You need a trade management planner where you plug in all your numbers and it tells you how many trades you need to do a month. It tells you your price range that you can trade, your share lot you should use. It just spits it out for you. It's great. Howard Johnson, my partner, developed it, and I saw that and I went, whoa, I need that for my students, because it was amazing. Trading journal is mine. You need to have a trading journal if you're trading as a business. So you document all of the daily market condition scans numbers, the bias of the market, all that stuff. It's an invaluable tool for trading. Charting software that includes scans and sorts. I'm sorry, guys, but you're going to have to spend some money on charting software if you want to be trading as a business. You can write it off, and it gives you the opportunity to have far more scans and sorts, so you don't have to say, well, I need to go to somebody who's recommending a stock so I can make him wealthy. Hybrid leading indicators are a must. You can keep all of your favorite indicators. It's fine, but they're not enough. They get you in late. Controlled bracket order types. Howard Johnson created a special order type. He called up at that time years ago, many years ago, market maker Herzog, and said, could you take a look at this and see what you think? Because we're going to be presenting this to some of our students on our trading floor. And the market maker goes, this is brilliant. Can I use it? So our order type is used by the market makers and by many professionals. It's only taught at our school. Buy entry signals, sell short entry signals, exit signals, or trailing profit stops for taking profits. You have to use these because the reversal and continuation patterns are just that. They suggest a reversal. They suggest a continuation. They're not an entry signal in and of themselves, except for engulfing white. That really works if it's not too large. Run gain potential calculation. Do you calculate previous runs of that stock to determine how far that stock is going to run next based on volume and other large lot indicators? Because this tells you whether it's a high risk or a low risk transaction. Trade calculator for automated risk analysis. You just plug in the numbers and it spits it out for you. Stop loss placement. Put it in the numbers in the calculator and spits it out for you. And your entry price. Trade calculator spits it out for you. Share lot size. How that comes from your trade management planner. Price range. Risk profit ratio from your trade management planner. Estimated hold time from your trade management planner. An exit point, whether you're going to hold and let it take it out. Usually we see pro traders nudge sell, and that's when you sell. So those are all the things that you need to have in your arsenal of trading, because these tools discipline your trading and make it super fun and super easy. It's just, and trading should be fun. It should be, I love my job. And I tell people, I love my job because it's fun and it's very exciting. So market condition analysis tells you who's in control of price, what technical patterns are prevalent and reliable, how price will behave at resistance and support. If you're in a trading range, it's totally different than a platform market condition. What trading styles work best? What trading styles you use? Probably most of you are day trading. Throw that away. The SEC has tons of volumes that prove that 99% of all the retail day traders who try it, work on it, lose all their capital base, owe their broker massive margin, and either give up or start teaching so that they can make some money from teaching. So then they can go back and start trying to day trade and fix it because they're just sure their strategy works, because the strategy worked for a little while and then suddenly stopped working. Why did it suddenly stop working? Market condition, who controls price, what's going on with resistance and support. Oh, this market is got stuff going on that you're not paying attention to as day traders. Which indicators to use? Usually you'll have a set and you just adjust the period settings. The inherent risk of trading that specific style. Day trading is the riskiest of all. Swing trading has far less risk. Platform position trading has very minimal risk. I had a student who wanted to stay home and raise her kids. She came on. She didn't know anything about the market when she started with me. Brand new beginner, $3,000. That's all she had. And she wanted to trade. And so I said, platform position trading because of your low capital base. And her husband was this high big wig up in Boeing, money manager. They graduated from MIT. Brilliant guy. So was she. And he made buco bucks, tons of money. And she comes to me and she goes, Martha, I made more money trading platform position trading than my husband made at his job. And so they went out to celebrate. What trendline patterns are common? Trendline patterns matter and you don't know them. Which entry and exit signals are most reliable for that market condition? The strength of price and volume patterns for that market condition. Market condition tells you how and when to trade. who is controlling price, because there's always at least one or two of those 12 that are controlling price. So who's controlling price? Because that tells you how it's going to behave, what to expect in near-term price action, where to find excellent picks, how to enter, and when to exit. Market condition analysis is a roadmap of which market participants are actively trading, which are sidelined or waiting, and where we can find where we are in the overall long-term, intermediate-term, and short-term trends, which you got to pay attention to. When you learn market condition analysis, you are in control, and trading discipline is automatic. You don't have to go, oh, I have to discipline my trading. No, you don't. You just have to figure out how to trade the right way. So one of many relational analysis skills, patterns of reals dark pool activity, is the shift of sentiment pattern. I'm going to go through this pretty quickly because I'm short on time. This is a combination candlestick. So it's the shift of sentiment is right here, and it tells you that dark pools have seized control of price. The shift of sentiment pattern is very reliable, and we use it in all of our activities to check what's controlling action and this extreme price action that's caused by HFTs. The shift of sentiment identifies the buy zone. So it's very easy to track. And this is a bottoming stock. All bottoms form with a bottoming stock. Who is control of price? Dark pools. HFTs are high frequency trading companies, and I can show you right here. Huge gap downs and long black candles on high volume are HFTs. They are maker takers and provide liquidity for the markets. HFTs are just the opposite of dark pools. They want to move price in huge gaps and huge runs. HFTs are trying to force price to move quickly in huge patterns, and you chase them because you get this recommended stock and they're already in it, trending it down or up. Gaps at market open are far more prevalent than recent years and prior years, and they're going to happen more often. Huge gaps and extraordinary long candles are the primary candlestick patterns from the HFTs. Smaller funds, as well as retail traders and investors, often chase HFT activity. Don't do that. HFT candles are typical one-day candles, and they don't change the trend very rarely. So these are all the candles. These are the patterns that show HFTs. So if you have volume bars, or you should, and you have the candlestick patterns, so use those. This is one of the hybrid leading indicators, so you won't have that one yet. High frequency trading firms use formulas to find anomalies. When cluster orders are identified, the quantitative analysis formula triggers automated electronic orders that cause whipsaw action or extreme patterns. All high-frequency trading is done via a computer-generated order. There are no humans trading at these computers. These can cause major price trend disruptions, mostly intraday. Retail traders trading has become the harder because of this. So normal order flow is like this, and this is what we want. You cause cluster orders because you're all trading in chat rooms, all the same thing. Dark pool control their orders and are hidden. So using indicators properly, you need to know the indicator category, what market data is used in the formula, what market condition was underway at the time the indicator was written, and what the limitations. All indicators have limitations. MACD doesn't work very well in a sideways market. It fails all the time. Stochastics is even worse. Is it for short-term or long-term analysis? I go out and check some people's indicators once in a while when I'm out in public, and I'll go, what? This is a long-term indicator for short-term trading. No, you can't do that. What indicator patterns form and what each one means. There's indicator patterns within the patterns. Under what trading conditions does it work ideally? Every indicator fails at some point. Which subordinate indicators to use with that indicator, if any? I always advise subordinate indicators because it really helps with the analysis. The exact formula is only useful if you're a mathematician and wish to alter that formula to your own use. When you alter an indicator, it becomes a proprietary indicator unless you release a formula, and that would be very dumb. Professional traders have their formulas. They don't release them. I have formulas that I have, and I give indicators on charts to the students. Dark data used in stock indicators is price, time, and quantity. That's it. But it can be manipulated in a gazillion different ways. Two data are needed to create a stock indicator: price and time, which most of you use, quantity and time, which most of you don't use. Price time indicators lag all the time. They have to. Price has to move before the indicator can signal. Quantity and time indicators sometimes lead. Volume will be declining, and you'll go, okay, well, that run is over. Price, time, and quantity indicators lead most of the time. Why? Because hybrids reveal dark pool activity, and dark pools don't lead price. So you have dark pool patterns, accumulation going on. Then pro traders will get in the mix, and suddenly we start having these nice runs up. So you're all what ahead. You have this on the watch list. Oh, here come the pro traders. All right, I'm going to get into the stock. Boom. Quiet accumulation, gray bars. That's showing that there's accumulation. And we have this very fun thing. This is a buy zone. And pro traders and smaller funds pushed it up, and then the stock went higher and went into another sideways range. And then all of a sudden, the stock was gapped down by HFT, by memes groups, and then it went right into the buy zone of dark bulls, and they pushed it back up. So all the selling short that the memes groups did that day, they lost money big time. Summary of psychology of the market. Understanding the dynamics of the market participant cycle and how each different market group impacts price, trend, market condition, and how each affects your decisions is a major aspect of the inner market. It is the psychology of the entire market, not the psychology of you. You don't need to worry about that as much as everybody tells you you do. When you are aware of who you are trading with and who you are trading against, your income from trading will increase naturally. And you'll have self-confidence and high self-esteem. And you'll stop worrying about things. So it'll all just kind of be a fog that just disappears. Identifying the market conditions will give you a roadmap as to how, when, where, and what to trade at any given time. This takes the guesswork and emotions out of trading. Using a trade management planner, trading parameters, and trading tools that were created for the modern stock market enables you to manage your time, reduce stress, improve results, and lowers overall risk. Learning how to become one of the elite traders, semi-professional traders trading as a business for consistent monthly income, also integrates discipline in your trading. Psychology of the market is all about the various groups who all have different activity in the market over time. Using the more tools to streamline your trading gives you more time to enjoy life because it simplifies the whole process, makes it easier. Your trading doesn't have to be hard. It's not that hard. So I would like to invite you to our TechnoTrader courses campus for those of you who might consider joining us and becoming a student. I can tell you right now that our training is not for everyone. I'm looking for students who are very serious. I have students who go professional after they work with me. I have lots of students who trade as a business and make monthly income on a regular basis. That's what their income is. I have people who work part-time and have monthly income that augments it, because all of us are facing this crisis of the middle class of America is disappearing, even with higher wages and inflation is disappearing. So you're going to have to find an alternative source of income. But you can't just go gamble in the market. You can't just rush into things and say, okay, well, I'm just going to have to live with this. So I invite you to join us, and we have these free indicator of mini courses that you can take. You do need to register, and we're not going to hound you either. We're going to be right for you or we're not. So that's my presentation. Thank you for joining me today. I hope you learned a lot. I hope you took a lot of notes, and I wish you the best of luck in all your trading. If you have any questions, you can send them to David and he can forward them to me.